Good morning, everyone. Today I would like to show you how to trade a crude oil instrument in an inside day. For example, like the past Thursday, February 12, 2015. This is the chart, corresponding chart. Let's take a look at the corresponding three-range chart between 8 a.m. right here and 10 a.m. more or less right here, 10, 10:20. Something like that. Here we can see a gray color background most of the time, with the only exception of this very short period of time between 9:34 and 9:40, just a few minutes. This color background is a trend and multiple time frame background. It was built based on this criteria, indicating that we are inside of the previous day bar's body. So today we are completely inside. It's very clear. All the time, let me compress a little this. You can see this is the previous day body. Okay? And we are all the time inside the previous day bar. Right? Okay. Let's analyze now how big the useful trading range is. This is what we see here, and from the technical analysis point of view, this is for us the useful trading range, because the previous day opening level and the previous day closing level are very strong support and resistance reference. So from this gold dot line, the prior day's opening level, to the gray dot line, the prior day closing level, we confirm about 150 ticks. This is 49.50, this is 51, 150 ticks of total range. That's fine. It's more than enough to carry out our trading strategy. In this case, Mini Falcon. This is an automated strategy, a trading total automated strategy, with 65 ticks target and 20 ticks as original stop loss. But, and obviously we always have a but, we can trade this strategy, we can run this strategy if, and always and if, the rest of the relevant support and resistance elements are not reducing in some way this 150 ticks trading range. What are we talking about? What support and resistance elements are we referring to? Well, we are talking about this long-term moving average. The violet one is the thickest, is the 450 exponential moving average. And at the same time, it's important the 200 moving average, the red one, okay? Or both at the same time, because when they are more or less close, okay, they are reinforcing to each other. You understand this? So the important thing in this case is the area between both. Why we have to do that? Well, this is because the referred moving average are both very strong support and resistance area. So they can divide or split the useful workable trading range, and we have to take into account this situation. For example, in this case, we can see that the previous day bar body of 150 ticks is now reduced to these 50 ticks, below the 450 exponential moving average at 8 a.m., more or less about 8 a.m. And it's also reduced to 100 ticks in this case, above the 450 moving average at 9:10, 9:15. This trading range reduction was responsible for this very poor but still profitable short trade, which gave something like 35 ticks positive profit. This one. This is because we have only 50 ticks to the end of the previous day bar body. But the long trade in this case had much more space, more room. For this reason, it was much more successful. because the useful trading range above the 400 moving average was exactly double, 100 ticks. So mini Falcon, which is a 65 ticks profit target strategy, could develop very nicely the trade with room enough to reach the 65 tick target right here, exactly into the end of the previous day bar. Is that clear? I think it's a simple concept and it makes sense. You understand that. Look, the next trigger was right into the resistance, and it had problems. Yes, it was only a break even, but no profit were reached. Okay, the prices were a little above, slightly up here into the prior day's high, this green thick solid line, and it found supply more or less in the middle of this area between the referred previous day high of the day and this highlighted previous resistance area. You can see that this area is still valid. The strategy made another long entry, which was a losing trade. Okay, this is a loser. This losing trade, in spite of nobody likes to lose money, is positive because it keeps the prices between the still ascending 400 moving average and yesterday's high of the day. The prices were compressed between those levels. Okay. In order to take advantage of a larger free or useful area when the prices went down, you can clearly see this effect. So now we have a larger area of 135 ticks, workable trading range, so we can short here, confident of having good chances to get a decent profit. We couldn't get the target because the strategy protected profits here, right here, as a part of this bounce, but we still got 55 ticks, a very nice profit of $550 per contract. Okay? Well, I think it was a very useful lesson, and thank you for listening to this video. Have a good day. Bye-bye.